Pankaj Tibrewal joins us. Let's connect with him and let's understand what he makes of the market. And क्या बात है जी, happy Holi already pink shirt पहन कर आए हो?
Good morning, Nikunj bhai. How are you?
Well, could have been better if markets were better.
These are all cycles, Nikunj. You have seen it all across. So I think we should not be too worried. And on the contrary, I think after a long time, we have started to turn a bit constructive on markets now. And I think 3, 4 points which probably I would like to draw your attention to. I think over the last 18 months, the slowdown which we saw, and especially from March 24, was a combination of both monetary and fiscal tightening, which we have been seeing. And I think both at the margin have started to reverse. And at least in my career over last many, many years, except GFC and COVID, I have now not seen a policy pivot as strong as what RBI has done in the last 45 days. And I think that's getting clearly ignored by the markets today. RBI has already announced a liquidity injection to the tune of 6 lakh crores, very well ignored by the markets. Policy relaxations in terms of risk weightages, ignored by the markets. And the third important point is the policy rate cut action after 5 years, ignored by the markets. So I think the RBI policy pivot is a very important and substantial move from a macroeconomic perspective. And over the next few quarters, we will start seeing the impact at the ground level. The second is the government capex. We were minus 12%, if you remember, till November. December, January has been very strong months, and so is Feb looking to be. And I think from that perspective, when we speak to the core industries at the ground level, whether it be cement, whether it be the long product steel, wires and cables, batteries, all are talking about a better fourth quarter and better economic environment and demand environment. The third important part is the fiscal consolidation. Nikunj, don't forget, we are the only country in the world from a peak of 9% on fiscal, we have come down to 4.8, and next year is expected to be 4.4. And from there on, I think the fiscal consolidation will only be 20 to 25 basis points compared to the last 5 years, we have seen the maximum fiscal consolidation. So I think if you combine these three things together, what it translates into corporate earnings is that this year will be a softer earnings growth environment, FY25. And the first half, we saw about 3 to 4% earnings growth on headline basis on the top 500 companies. Third quarter was better than the first half in terms of reported number being 8.5%, 9%. And our sense is fourth quarter will be better than the third quarter. And don't forget the next 2 quarters in FY26, the first and the second quarter, optically will look very good because the base is very low. So my sense is that economic activity has started to pick on the ground. The liquidity, which was very, very tight for almost 12 months, which we have been talking about, has started to ease. And when we speak to dealer, distributor, ground people, I think we have started to get the feedback that liquidity has started to improve. And that's something which will show full throttle probably a quarter or 2 quarters down the line. So from a fundamental perspective, things have started to get better than what it was for the last 6-12 months. And I think markets will take cognizance of that as you move ahead. So that's the first part on fundamentals. The second part is sentiment. I think if you speak to anybody on the ground today, 9 of the 10 people are extremely pessimist because whenever they come in the morning and see the screen, it's all red. So I think the stock prices are driving the narrative. And our sense is that it's a great time for managers to pick up right companies, right stocks, because earlier in the last 2 years, you didn't get the time to research. Now will be the time to go deep into the companies, pick up your winners. And please don't get me wrong that it will not be the same way the market saw in the last 3 years. I think it will be a range-bound market. It will consolidate itself and it will be a stock pickers market in the next 12 to 18 months. So sentiments are bad, but I think that's a great time when you pick up your winners over the next 2, 3, 5 years. And the third is the flow. Everybody is asking, FIs कब वापस आएंगे? When will be the घर वापसी of FIs? And domestic flows have started to slow down, and that will have a bearing. My sense is that with the correction in the US markets, it's a great news for emerging markets, including India. And I think
Right.
sooner or later, FIs flow should resume, is my guess. CY21 till now, FIs have withdrawn $6.5 billion. And the entire money of $2 trillion has flown to US markets over the last many years. With this correction in US market, I think capital allocation and capital flows will rotate. So I'm not too negative on the FI flows resuming back sometime during the year.
अब आपने सब तो बोल दिया. What do I ask you? You've spoken about valuations, you've told me about technicals, you've told about macro, because markets are a function of valuations, technicals, and markets, valuations, earnings, and technicals. You brilliantly outlined all the three factors.
We should talk about sectors and how will investors make money.
And there you've said you like capex and you like wire companies, you like cement, right? So you like cement. You've been liking cement for a while now. So
Yes.
let's look at data where I like to contradict you.
Yes.
Let me contradict you on the tariff part, which is that we don't know which way things would move. And I'm assuming something will move here or there. So this alignment which will happen because of this entire tariff change, how exactly are markets prepared for it?
So globally, I think there will be a lot of noise, Nikunj, on tariff, and you are already seeing that. But in that environment, I am taking a slightly contrarian view that India probably over the next 2-3 years will be the biggest beneficiary of this geopolitical issues which are going on. And don't forget that finally, Mr. Trump is a great negotiator rather than being a great politician. And when I say that, look at what happened after post Mr. Modi's meeting. Suddenly, you saw Tesla having LinkedIn post for recruitments. Certainly, in the last 2 days, you saw Starlink getting, having a JV with Airtel as well as Jio. And these are all indications towards that give us access to your markets, we should be okay. And our sense is that when we even look at the reciprocal tariffs and what tariffs have been imposed on China, Mexico, Canada, and other places, I think we should be relatively much, much better. People are concerned about pharma, but don't forget that 60% of the generic drugs supplied in US is from Indian pharma companies. And if you raise the tariff, already these companies are not making too much of money. They are making wafer-thin margins. Many will just move out of some of the molecules, and there'll be a huge shortage, which will lead to huge price increase. So I don't think government will take that chance in US, at least on the healthcare side. And rest of the segments, gems and jewelry, carpets, textile, there could be some reciprocal tariff. But from a medium to long term, if you look at, and hoping that relationship between China and US doesn't improve, you will be surprised that a lot of work by the US-centric companies will flow to India rather than going to any part of the world. So in this noise, I'll be extremely, optimist on looking at companies which have moats around them, and they can be a great substitute for many of the Chinese and other companies based out of either Mexico or Canada. And that kind of a work and scalability can come back to India in our view. So I don't think India will be as much impacted as the noise is made out to be, but over a period of time, there could be many opportunities for the manufacturing set of companies in India. Just if you look at the horizon for the next 2-3 years and take an objective call that if it attacks both the largest markets in the world, which is China and India, where will US sell its defense equipment, where it will sell its energy, and where will it get markets for US companies? So think about it from an objective angle, and you will think that India probably could be well placed. Right now, the noise is against us, against the markets, so people are getting carried away. But over a period of time, you will come to figure it out.
Right, interesting. Pankaj, since it's going to be quite difficult the next 1 year, too many moving parts at play, what should investors be doing when it comes to their sectoral biases?
So one, I think what we have been saying that don't get carried away by narratives. Over the last 2-3 years, money making was so easy that everybody had left their core work and just focused on stock markets. I think that era probably may not come back in a hurry. And hence, I believe that asset allocation and discipline will make a difference of whether you make money over the next 3 years or you don't make money. And from an asset allocation, I mean that out of 100 rupees, you need to have 40, 50 rupees, depending on your risk appetite, on flexi cap, large cap, and the rest 50 rupees between thematic, small, mid, and other parts, and part also in gold. So I think asset allocation, discipline, patience will be the key force over the next couple of years, which will decide whether investors make money. That's first. Second, on the sectoral preferences, I think after every cycle, we see what made you money in the previous cycle. Generally, the leaders are very different. And our sense is that whatever policy action has been taken on, I think private sector banks and NBFCs look to be in a very decent position, and valuations have corrected over the last 3-4 years, and hence they seem to be in a right position. The second sector we are liking is specialty chemicals. Already in this year, calendar year, in this correction, we are seeing among the top 500 gainers, a few of the name emerging from chemical sector after a long time, and the underlying is started to improve. The agri destocking which was happening is behind us. So that's the second sector. Cement, I think, is started to see consolidation, price increase, and this quarter could be much better than the third quarter for most of the north-based cement players. So that's the third sector. The fourth is a contra sector, which is metals. I think metals is at a point of 2001 to 2003 in terms of profit contribution to overall corporate India profitability. And those are mean reverting trends. Today, you can't say anything about, positive about metals, but I follow that profit pool contribution trend, and that's showing that metals probably it has a very interesting juncture. And in this correction also in the last 2 months, generally metals are very high beta. And this time their behavior has been quite different. So that's showing that some positioning is happening on the metals and mining sector. And the last but not the least on the consumption basket. I think many stocks on the consumer discretionary part are 3 years, 4 years, zero return, valuations have time corrected. And there have been few of the reasons why they have not done well. And I believe that next couple of years could be seeing consumption resuming back. The kind of spend we are seeing at the ground level in terms of welfare schemes, in terms of tax cuts and all, will start to show its impact in FY26 second half. So I think consumption is another area where we are positive upon. So these are few of the sectoral biases we have in our portfolio as you move in FY26.
Okay, Pankaj, great to have you on the show. Thanks for joining in as always. Good speaking with you.
Thank you. Thank you.
If you like this video, then like, share and subscribe to ET Now.